Hi, this is Tom Soane, and today I'm going to share 7 ways that you can find the right property investment deals and also how to avoid losing money. It's a really important topic, and in this part I'm talking specifically about due diligence, the things that you must check before you even view a property. And you can do all of this from your phone, from your computer, at home, wherever you are. And I'm going to focus all of this on buying a flip to let property, which is sometimes called a BRR or a buy, refurbish, refinance. Basically, where you buy a property, you add value through refurbishment or addition or extension or a conversion, and then you extract your money back out through a mortgage or finance or a loan, and then you let it out as your return on investment. And this is all part of my 0 to 4K property investment webinar, where I talk through an actual strategy of how you can go from 0 to £4,000 net profit every month through property investing. And it's a really easy and simple strategy and an effective strategy to get anybody started in property investment. So if you want to join me on that, just click the link below or above, wherever it is, and then I'll send you the details. It's on December the 16th at 2 o'clock. Anyway, due diligence. Now, these are the things that you must do and research and check before you even go and view a property. Really, before you even book a viewing. Now, let's start with the deal value, and that is easily calculated by working out the top value of the property once the whole job is done, minus your investment required to get it there, minus the costs and tax you're going to incur along the way, and minus a small amount of profit margin. And then you need to calculate the rent value, because that is effectively your exit to be a return on investment. You're going to exit the investment to become a return on investment by renting it out. So you need to calculate the rent value. Pretty obvious stuff so far. Right. Now we're going to get interesting. We need to have a look at the current demand for that type of property in that area for tenants and for purchasers, because the sale market normally has a direct relation with the lettings market. So that if there's a highly active sale market in a specific area for a specific type of property, there's also going to be a high activity of lettings too. So you know, if it's a really active sale market, the chances of you renting that property out quickly are strong. So the way to do that very quickly is you search for a particular property type in an area, and then increase the search radius by about 1/4 mile. Give yourself a few properties to see there in that list, and then go into filters and include sold properties as well. Now, if you've got, say, 20 properties on the market in that particular price category and of your particular type of property, and there's also 20 properties that have also been sold, you know there's a really good active market there, so you know demand is high. That is positive. If it's the other way round and there's loads of properties on the market but not many sold, then you'll also know that that is a low demand area, so you'll need to build that into your calculations. And there are a few tips and hints that you can use to get that property at a much better price in those scenarios, but we'll go through them another time. Next, you need to work out the competition. What is that property going to be up against if you buy it and then do it up? So if you buy that property, it's a 3-bedroom house, let's say, and you add the value by refurbishing it and it becomes a nice, beautiful, brand new 3-bedroom house, then what other properties are going to be on the market at that particular time? And there's a quick way to work it out. Obviously, you search properties on the market, but I want you to think about this in a slightly different way. First of all, you need to work out the number of properties that are unsold and unlet. So unsold properties, they might well be up for a bit more negotiation. You certainly shouldn't sell, or you shouldn't buy a property for the top price if it's been unsold for a little while, right? There's a bit of room for negotiation. But same with unlet properties. What does that tell you? Well, unlet properties tell you that if there's properties that are unlet in that category, that price range, then it might be a bit harder for you to rent it out as well. So think of it like this. If your property is going to be sat on the market for 2 months once you own it, not only are you going to lose 2 months worth of costs, but you're also going to lose out on 2 months worth of rent. So the way to work that out is to spread that loss of rent over 4 years, which is the average tenancy, and then work out if you can get your money back over that 4 years by increasing the rent at some point. Real simple calculation, but we'll go through more of that in the webinar as well. The next thing you can look at is the pictures of the property. And before you even go to the property, the things that you can check for in the pictures on the listing are things like central heating. You can have a look, are the radiators good or bad? Do they look terrible, or are they pretty up together? You can carry on using them. What's the boiler like? Maybe there's a picture of the boiler, maybe not. But sometimes in the pictures you can see damp. Now, a lot of agents might not take photos of damp areas, which I think is silly because it's wasting their time. If you're a property investor and there's no, I guess, evidence of damp in that property, and you go out to see it and then you see a load of damp and you think, oh no, I'm not going to buy that, then the estate agent is just wasting their time. Make a note in the property listing that there might be damp. So stick that in there. But anyway, you can have a look for yourself just by checking out any dark spots. Perhaps in the bay windows, that's always a common area for damp. In the corners of the walls, around the skirting boards. If it looks a bit darker and a bit shaded in the pictures, then there's possible damp. Now, it might not be, but it's just giving you an idea. You can also have a look at the decor. Can you see wallpaper? Now, sometimes older wallpaper might take a bit more money to refurbish because once they pull all that off the walls, then you might need some areas replastered. So build that into your costs. You can also have a look at the flooring. Maybe you can reuse certain parts of the floors, carpets, laminate, lino, whatever. Also, you can check the windows. Do they look new or do they look old? You can even ask the agent these things, but in some cases you can see whether you need window replacements, door replacements. The front door, remember, is the first impression for that property. So if you want to get the top money in rent, then you need to check that you've got the right first impression to attract the tenants, to give them that wow factor. But also you can look at the kitchen. Now, here's a quick tip. If you have a look at the pictures of the kitchen and also the floor plan, and you think that you couldn't improve the layout of that kitchen, doesn't matter what condition the kitchen's in, if the layout is okay, you might be able to use the existing carcass of the kitchen, which is basically the sides and the back and the inside, and just replace the doors of the kitchen to make it look new. That might be a much cheaper way to get that property. But then when you're making your offer, you tell the agent, you tell the seller, you tell whoever you're offering through, it needs a new kitchen. But in the back of your mind, you're thinking, well, I'm going to spend about a fifth of the money on replacement doors and just touching up the existing kitchen. You might also need a sink, so check that too. Same with the bathroom. Sometimes just because the bathroom tiles look tatty or the floor looks tatty, people think they've got to replace the whole bathroom. You might not. If there's a normal bathroom in there, if it's a white furniture bathroom and it's reusable, reuse it. No problems. But you might have to retile, you might have to refloor, you might have to do some light refurbishment in there, but you might be able to save a bit of money. Anyway, how can you use the agent? Well, first of all, ask the agent. Just ask the agent, why are they selling? Now, 50% of agents are going to give you an absolute blaggy, rubbish answer, but the other 50% are going to be honest with you, and they're going to be forthcoming with information, and those are the ones you want to work with. But you can also ask what feedback there's been on viewings. I think that's a really important thing to know, because if everybody's going in there and saying it needs too much work, it needs too much work, then maybe there are some hidden things in there that you might need to just calculate for. But it also means you might be open to a slight better negotiation, because the owner might be fed up with people saying it needs too much work, it needs too much work. And originally they might not have thought it needs as much as it does. So you could slip in there, make a cheeky offer and get the property at a good price. But you can also ask the agent if there's any damp or any damage or any risks that spring to their mind that I should be aware of. And you could do that by email if you want. The agent should be able to communicate by email nowadays. Anyway, you can also ask the agent about the electrics. Is it an up-to-date electric installation? Does it have an EICR? That would be a very helpful thing if it does. but also the boiler. What's the age of the boiler? Once it starts getting above 10 years, you might need to think about replacing that boiler in the near future. So build that into your costs because it will be coming out of your rent. And lastly, here's a little tip about getting agents on board. Ask them for their opinions, their resale value. What do they think it's worth? What demand do they think there is currently for that type of property? Because if you treat the agent with respect and you value their opinions and you ask their advice, they're more likely to want to work with you, because remember, you're the buyer. You don't pay the agent a penny, so you're expecting them and hoping that they're going to work their socks off for you for free. So you can use the agent to help you get the deal over the line. The next thing to look at is appreciation. Now you can look back over the last 10 years and work out what property appreciation has happened over that 10 years, and then you can apply a percentage of that to the next 10 years. Because you're not going to be buying this property, doing the refurb and then selling it tomorrow. You're doing a flip to let, meaning you're going to keep hold of this property for at least 10 years. Hopefully anyway, if it's a good purchase, you'll want to keep it for longer. So you can also look at another way of calculating it. Either look at the appreciation on property values historically, and I'll talk you through how to do that exactly and scientifically in another video in this series, or also on the webinar as well, which if you want to join me, by the way, just click the link above or below, wherever it is. It's the 0 to 4K property investment strategy, by the way. I think I mentioned it earlier. Anyway, so if you want to work out a different way of your appreciation, then you might want to base it on inflation. So inflation, you can have a look over the last 10 years and see what inflation has happened in the economy over that time and apply that same percentage to the next 10 years. It's not an ultimate exact science, but it gives you a way of forecasting what the growth of your money and your asset value is going to be. The next thing to check, and there's two more things here, so the next thing to check is mortgage rates. Real quick, really easy, speak to a mortgage advisor and find out what mortgage rates are currently available for a buy-to-let mortgage. If you don't have a mortgage broker or you haven't spoken to one that you absolutely trust or can rely on, give me a shout, I'll connect you up with mine, and my mortgage advisor will just tell you what mortgage rates are currently available for buy-to-let properties. Really important. The next thing to do, and the last thing to do, is check sold prices for this exact property. I'm not talking about sold prices in the area, because you will have done that at the beginning when you're checking out the value, right? Hopefully. But you're checking the sold prices for this exact property. If this property has been bought and sold a lot of times in the last 10 years, then it could be that it's a bad area for reasons that are not immediately visible. It could be bad neighbours. It could be a bad location for other things. Maybe the parking situation is just intolerable. Maybe it's too far away from local amenities. Maybe it used to be a good school and it's not anymore. So one way or another, you've got to check the sold prices for this exact property that you're looking at right now. So all of those things together will give you a really good picture of whether this is a good property or not. And you will have done some due diligence as well. So that means that you can work out how to not lose money, because that's the important thing. Don't lose money. So all of this stuff goes towards avoiding losing money, right? Anyway, I mentioned about the webinar. It's the 0 to 4K property investment webinar, and I'm going to talk through an actual strategy of how you can go from zero, absolute zero income, zero profit per month, all the way up to £4,000 net profit per month through property investing. And it is really a simple strategy. It sounds like it's a bit of a dream. How can I do that? But it is an actual property investment strategy. They teach it on the training courses that you can spend thousands on. Well, I'm going to give it away for free because I don't believe you should invest or have to spend loads of money for someone to tell you these things. There are no secrets in property investing. There's just stuff you know and stuff you don't know. So click the link above, below, wherever it is. Join me for that webinar on December 16th at 2 o'clock. 2 o'clock? 2 o'clock. And I look forward to seeing you there, and I will speak to you soon. My name's Tom Soane.